Andy Panko, owner of Tenon Financial. Welcome to Retirement Planning Demystified. If you have a 401k and some of the investments inside that 401k are company stock of your employer, you may be able to save yourself a lot of taxes on that stock by taking advantage of something called Net Unrealized Appreciation, or NUA. I'm about to explain what that is and how you can benefit from it. And if you like this video, please click the subscribe button below the video. But before we start, remember this video is only general explanations and education. It's not specific tax, legal, or investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor. Whenever you have a tax-deferred retirement account like a traditional IRA or 401k, it generally doesn't matter what positions are inside the account and whether they're at gains or losses from when you first purchased or acquired them. Because with tax-deferred accounts, all of your withdrawals will be taxed at your ordinary income tax rates, regardless of what happened inside the account along the way. However, if you have a 401k where at least some of the investments inside the account are securities, such as common stock, issued by that employer, you may be able to save yourself some taxes on those securities, particularly if they're currently worth more than what you originally paid for them, or more than the price they were when your employer gave them to you. Any amount of gain on those positions is called Net Unrealized Appreciation, or NUA. Let's look at an example. Assume you have a traditional tax-deferred 401k and it's currently worth $1 million. Let's assume you have $400,000 worth of company stock inside the account, and the other $600,000 is in other investments such as mutual funds. Of the $400,000 of stock, assume $200,000 of it is the original cost of the shares, and the other $200,000 is gain or growth that has since occurred from when you first got the shares. And it's important to note that the original $200,000 cost could have been from shares you purchased yourself inside the account, or they could have been shares that were given to you from your employer as a form of 401k match or discretionary contribution. Either way, the shares were worth $200,000 when you first received them, and you have not yet paid taxes on them. That original cost is called basis, and the $200,000 of gain is called Net Unrealized Appreciation, or NUA. So now let's look at what would happen if you leave or retire from your company and do a regular rollover from your 401k to your IRA. You'd first open an IRA if you don't already have one, and then would transfer all of the positions into the IRA. Upon completing that transfer, or rollover, all of those positions would now be in your IRA, and your 401k would basically close and go away. Once everything is inside of your IRA, there's no longer any reason to make any distinction between your company shares versus all the other investments, because everything in the IRA will functionally be one big homogeneous pot of investments, at least from a tax perspective. Because it doesn't matter what happens to all the various investments inside the IRA. Whenever you take money out, all withdrawals will be taxed at your ordinary income tax rate at the time. In other words, whether you sell company stock or sell other investments inside your IRA to generate the cash you want to withdraw, it doesn't matter. Every dollar that comes out of the fund will be taxed as ordinary income. Now let's see how you would go about doing an NUA distribution and how that would impact the taxability of things. We'll again assume you start with the same $1 million 401k that has $400,000 of company stock and $600,000 of other investments. To take advantage of NUA, you would similarly need to have an IRA, but now you'd also need to open or already have a regular taxable brokerage account. Just like before, you'd still roll over your non-company stock investments into the IRA, but here's where the processes differ. The $400,000 of company stock would instead get transferred into your taxable brokerage account. All said and done, you'd now have the $400,000 of stock in your regular brokerage account, and you'd have the $600,000 of other investments from your 401k in your IRA. So, why does NUA matter and how could it potentially save you on taxes? Let's take a look. Here's what was just transferred or rolled into your normal brokerage account in your IRA. Like in our previous example, all of the positions that's in your IRA will eventually be taxed at your ordinary income tax rate whenever you take the money out of the account. It's the company stock that's taxed differently than in the previous scenario. The portion of the value of your company stock that represents the original cost or basis of the shares will be fully taxable to you in the year you transfer the shares from your 401k to your taxable brokerage account. And that will be taxed at whatever your ordinary income tax rate is at the time. Now here's the real magic of this whole NUA process. The portion of the value of your company stock that represents the gain, or NUA, of the shares won't be taxable until you sell them. And then when you do, the NUA will be taxed at the long-term capital gains tax rates instead of your ordinary income tax rates. Why does this matter? because long-term capital gain rates are lower than ordinary income tax rates. Taking advantage of NUA sounds good on the surface, but you're probably wondering how much you can actually save in taxes. So let's put some numbers to our example. Here's some basic calculations for the scenario we just went through. I'm assuming this is for a married couple where all IRA withdrawals will eventually be taxed at the 22% federal income tax rate. And I'm assuming the couple's current income tax rate is 24%. And I'm also assuming the couple's long-term capital gains rate would currently be taxed at the 15% rate. Let's first look at what their taxes would look like if they did not take advantage of NUA. When they eventually withdraw the $400,000 of company stock from their IRA, everything will be taxed at 22%. This means both the $200,000 of cost basis and the $200,000 of gain on the shares would both be taxed at 22%. All said and done, the couple will pay $88,000 in tax on the company's shares. On the other hand, if they instead took advantage of NUA, then the cost of the stock will be taxed differently than the gain or NUA. In our example, I'm assuming the couple is currently in a relatively high income year, so they'd be paying 24% income tax on the cost basis of the company's shares in the year they transfer the shares from the 401k to the IRA. So that's $48,000 of tax on the cost basis. However, the $200,000 of NUA would be taxed at only 15% when the shares are sold, which means there would be only $30,000 of tax attributable to the NUA. All said and done, the couple would only have to pay $78,000 of federal tax on the company shares in this case. As you can see, by taking advantage of NUA, the total federal tax bill is about $10,000 less than it otherwise would be. That's the potential value of not letting NUA go to waste by just rolling it all into an IRA instead of transferring the company shares to a normal taxable brokerage account. Now keep in mind, this is just one example with lots of assumptions. The value of the tax savings of doing NUA can be drastically different depending on the specifics of each case. As an example, what if there was only $20,000 of original share costs instead of $200,000? In that case, there would be much more NUA and therefore much more potential tax savings to be had. But, on the other hand, if the original share cost was something like $380,000, then the NUA in this case would be negligible. And the current tax you'd have to pay on the $380,000 when you transfer the shares to your brokerage account would be quite large and likely not worth the little bit of tax savings you get on the NUA. In other words, the smaller the cost basis and the larger the amount of gain in your company shares within your 401k, the more attractive NUA becomes. There are a few other important things to keep in mind when attempting to do an NUA distribution. First, the distribution of company shares is considered a normal distribution from your 401k. As such, like any other normal distribution, if you're under 59.5, there may be a 10% early withdrawal penalty. However, if you separate from service from your employer in the year you turn 55 or later, you may be able to take advantage of penalty-free withdrawals under something called the Rule of 55. For more information on this, check out my other video, What is the Rule of 55? Next, in order to do an NUA distribution, you need to empty out the entirety of your 401k plan. In other words, you can't just choose to take out some of the shares and leave the rest of the shares or the other investments behind in the account. You have to take a lump sum distribution of your entire 401k account. With that said, you can choose to NUA just some of the shares and then roll over the rest of the shares and the other investments to your IRA, but nonetheless, you need to empty the whole of your 401k in order to be able to take advantage of NUA distributions. And speaking of NUA distributions, remember the cost basis of the shares you transfer to your brokerage account will be considered ordinary income in the year of the NUA distribution transfer. That means you'll have to plan accordingly because you're going to have a higher tax bill that year. Like if you're doing an NUA distribution where the cost basis of the shares is $200,000, as in the case of our example, that's going to be tens of thousands of dollars of federal income tax owed, plus whatever state income tax is applicable in your state. Another thing to remember is that the NUA distribution will always be at the reduced long-term capital gains tax rates, regardless when you sell the shares, even if you sell them within a few days of the NUA transfer. However, any subsequent gains that the shares have in the regular brokerage account will be subject to regular long-term versus short-term capital gain rules. Normally, if you sell a position at a gain and you only held the position for 12 months or less, the gain will be considered a short-term gain and will be taxed at your ordinary income tax rates. And if you instead sell it after holding it for more than 12 months, the gain will be taxed at the reduced long-term capital gain tax rates. As I mentioned, the original amount of NUA will always be taxed at the lower long-term gain rates. But additional gains may be taxed as short-term gains. For example, in our scenario, you had $200,000 of NUA at the time you did the NUA distribution transfer. Let's assume you then sell the shares 2 weeks later, and in that time the shares went up another $10,000 in value. In this case, Even though you only had the shares for 2 weeks from the time they went into the brokerage account, the $200,000 of NUA would still be taxed at the lower long-term capital gains rate. But the additional $10,000 of gain would be taxed at your ordinary income tax rates, as you held it less than a year in the brokerage account, and therefore the gain would be considered short-term. The final thing to keep in mind, unlike normal shares held in a brokerage account, shares with NUA from a 401k will not receive a step-up in basis at your death. Instead, the amount of the NUA on those shares will be taxable to your heirs as ordinary income. Therefore, from an estate planning perspective, NUA may not be the most tax-efficient means of wealth transfer, or at least it's not as tax-efficient as leaving normal non-NUA shares to your heirs. For more information about step-up in basis, check out my other video, What is Step-Up in Basis? Well, that's it for Net Unrealized Appreciation, or NUA. I hope you found this video helpful. As you can see, NUA can be a pretty technical process, and the tax savings aren't necessarily always going to be huge. But if you have a lot of company shares in your 401k where the dollar value of the NUA is large relative to the cost basis, you should definitely consider whether NUA makes sense for you. If you haven't already, subscribe to this channel so you can be the first to know when new videos are posted. And don't forget to subscribe to my monthly newsletter, Retirement Planning Insights, which provides informative retirement planning tips and info. Also, be sure to join my free Facebook group, Taxes and Retirement, where you can learn all about tax-efficient retirement planning. Thanks for watching. I'll see you soon.